Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So if you haven't been following the markets the last few weeks, April's just been ugly. It actually started off and finished March pretty good, and looked like April we were starting to sort of take back or pull back some of the losses from January, February. And then the Federal Reserve opened its mouth and talked about another half-point increase here coming up in May. And the markets just went volatility crazy. And I'll just show you a quick chart that sort of demonstrates sort of what was happening in March and like the first week of April, and then what's happened since. And there's no way to sugarcoat it. I mean, it's been all volatility to the downside. We've occasionally, over the last couple of weeks, had a couple of nice up days. But the nature of volatility is when it's being irrational, you'll have situations where the markets will go up rapidly for no darn good reason. And as we've seen the last few weeks, the markets go down rapidly for no good reason. The reason I say it's no good reason, and I talked about this in a prior update, is at least according to the media, the concerns that the market has is that the Federal Reserve is going to raise interest rates, and that's going to hurt the economy because it's the interest rates that are somehow the cause of our current inflation problem, which is actually what the problem the Fed is trying to solve by raising interest rates. The reality is that I don't believe that that's why inflation is as high as it is. It's not because interest rates are too low, although they are too low. The real reason is you have too many dollars chasing too few goods and services. And you have too many dollars because the federal government has been printing money hand over fist for the last couple of years, with the thought of trying to protect people during the pandemic. I get it. But we're now, sort of flooded with all these dollars, and our ability to produce goods and services to consume those dollars is still not quite where it should be. So that's the definition of inflation, right? You have too many dollars chasing too few goods and services, and inflation happens. You notice I didn't say anything about interest rates, right? Because interest rates didn't play into that problem. And so I'm not overly concerned about this market volatility right now because it's really just a fear and or greed, depending on who's making the trades, that's driving this market. Because the raising of interest rates are not the solution to our inflation problem. So that means that these actions are not really affecting the markets. They're not really affecting corporate America, at least in my opinion. So that's not what I'm concerned about. But what I do want to talk about today, and what I am a little concerned about, is the volatility and how people are reacting to it. So in order to just take just a second and talk about this, I want to level set on what volatility typically means to most people. And that means the market swings up and or down to an extent that's so high that you maybe can't tolerate it. And you'll often hear financial advisors talk about people's risk tolerance, and that risk tolerance is somebody's ability to tolerate the volatility, basically. And so one way that you can reduce volatility is, hey, you could be 100% in cash. That's one way, right? You're not going to fluctuate with the stock market one bit if you're 100% in cash. But with an inflation rate of 9%, sitting in cash for a year means that you actually just lost 9% of your money. So while it feels riskless, sitting in cash is clearly not the answer. The other thing that people tend to do when they think that the markets are going up and down just sort of too violently is they might go to fixed income. And as we've seen in the bond market here the last couple of months, the people that are in fixed income, it's a bloodbath over there right now. And it's because as interest rates rise, the value of fixed income investments goes down. And so here you have people that are fleeing to fixed income only to find, fleeing the volatility in the markets, fleeing to a bond investment only to find out 3 weeks later that their bond investment just lost 5 or 8%. So how do we handle volatility? Well, the first thing that I think is important to understand is I actually think people's ability to tolerate volatility really has to do with their ability to not have to touch an investment when times are volatile. So let me give you an example. Let's say somebody has $500,000 in their brokerage account, and it's 100% in the stock market. And as we are now, the market's down about 10% from its high. So they've lost $50,000 of value. And they're thinking, oh my gosh, how long is it going to take me to make that up? I've got some college expenses I've got to pay for my kids. We were thinking of moving and maybe buying a new house. Oh my gosh, we have to sell everything. So the reason that they had to sell everything is because their liquidity needs weren't satisfactory to handle not having to sell in a down market. And that's really how we handle volatility in our business here. And that is, we make sure that under every circumstance that people have enough money to handle most foreseeable needs for cash for a year or two or more in some cases, so that as markets are volatile, you could be 85 years old and have $1 million in the stock market as long as you have a couple $100,000 not in the stock market. Because then if the stock market goes down 10, 20, 30% because of volatility, not because of some underlying fundamental issue, well, you have $200,000 and whatever income sources that you might have to know that you never have to sell in the down market. And so that's really how we think people should be looking at volatility, not just can I emotionally handle the ups and downs, because the short-term ups and downs is like, you can feel that pain like immediately. You look at your online account statement and you immediately see, oh my gosh, I lost a bunch of money. I can't stand that. The problem is that if you go to cash, that's a much slower bleed. You might not notice your account balance going down, but all of a sudden a year from now, you can buy 10% less stuff with the money that you had. So you still lost 10%. So it's super important for us is that for people that want to take any risk at all, is that regardless of how far out on the risk spectrum that they want to go, is that they have the ability to tolerate the volatility, not because they can personally tolerate it, but because they have the liquidity, emergency fund, cash reserves that allows them to not have to look at their bank or their brokerage account every day so that they don't fret about it so much. And that's really why people hire me in many cases, is that I'm following the math to make sure we're getting in and out of things as appropriate based upon what the math says in the markets and in the economy. But I'm not making decisions because, oh my gosh, I've got to sell a bunch of stuff because we didn't have enough emergency fund. So I guess the overriding point here is, I get it, right? The markets have been incredibly volatile to the downside for the past several weeks. A lot of people are just really concerned because they're looking at the media and maybe logging into their online account summary and seeing that their values are down. But as long as you have sufficient cash reserves, selling in an irrationally or an emotionally volatile market is really just benefiting the person that you're selling to. It's not benefiting you. So I hope that makes sense. If anybody has any questions about this or any other financial issue, please feel free to call me, email me, post a message to this update. I will answer any question that anybody has, because it's right now there's a new norm for volatility, and I'd hate to see people jumping out at the worst time, at a bad time, because there have been worse times that have been worse, but jumping out at a bad time and then spending the next year or two, emotionally agonizing over, well, when do I get back in? So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.